Hi friends, in continuation of my earlier videos on the biases, behavioral biases which impact the investors, today we shall learn another bias which affects most of the investors. The name of that bias is disposition effect. Disposition effect means the temperament or the mood or a tendency to act in a certain manner in a given circumstance. Let's try to understand this concept of disposition effect using an example. You must have observed that a lot of investors commit the mistake of holding on to their losers and selling on the winning stocks or selling the good quality stocks at the earliest point of time. That means they hold on to the losing stocks and they sell off the good stocks in the hope and expectation that the loss, the book loss, not real loss, the notional loss which the stock is showing today shall get converted into gain over a period of time as and when the price of the stock appreciates beyond the purchase price. This is a very common mistake committed by most of the investors. The rational investor would do the opposite. He will sell off the poor stocks and hold on the good stocks. If he behaves rationally, he will have two advantages. Number one, his money will be freed from the bad stocks and that money can be deployed in good stocks. Number one. Number two, as and when he gets rid of the bad stocks, even at a loss, that loss can be set off against the capital gains which may arise on sale of some other stock or some other asset as per the provisions of the Income Tax Act. That means ultimately if you book your loss, you are saving some taxes also, provided you have capital gains from stocks or some other asset in the same financial year, or if that loss cannot be set off during the current financial year, it can be carried forward even into the future for set off against any future gain which may accrue or arise to the investor from stocks, from mutual funds or from any other capital asset. The provisions of the Income Tax Act are to be understood in this particular respect. The point I am trying to make here is that by holding on to the losing stocks, the investor loses the opportunity which the opportunity in terms of the potential profit or potential gain which he could have earned by deploying the money freed from the old stocks and redeploying the same fund into the good quality stocks. This behavioral mistake committed by most of the investors is called disposition effect. Here, another point which needs to be understood is that the same philosophy does not apply to the equity oriented mutual funds. That means if temporarily you find that some mutual fund equity scheme is underperforming, you need not necessarily get rid of that scheme until and unless you understand the reason of the underperformance. Because every equity oriented mutual fund scheme has a defined objective, and the portfolio of that scheme is created to meet that objective. What happens is that no investing philosophy performs well all the time. Sometimes growth investing works, sometimes value investing works, sometimes contra investing works, sometimes special situation investing works, sometimes momentum investing works, sometimes small caps performs, sometimes mid cap performs, and other times large cap may perform. And when the overall market is bullish, all kinds of equity stocks or entire market can perform, and all kind of equity mutual funds can also perform. Therefore, what happens is that in case of equity oriented mutual funds, if some stock or sector is not performing temporarily and there is good potential in the medium to long term based on the thesis of the fund manager, the fund manager may keep on holding the stocks even though temporarily they may be showing losses. The analysis of the fund manager may be that over a period of time, maybe 2 quarters, 3 quarters, 4 quarters down the line, the holding may start performing because the businesses are of sound fundamentals. It is only because of the temporary price mismatch or demand supply situation that the prices have corrected. Therefore, disposition effect is more applicable to your equity holding portion and less applicable to your mutual fund holdings. I hope that the concept of disposition effect is now clear to you. If you liked this video, kindly do share it and subscribe to my channel. Thanks a lot, friends.